Warren Buffett threw down a friendly challenge to the hedge fund folks. He wagered a cool $1 million that, in the span of a decade, the S&P 500 would beat a hand-picked group of hedge funds. Fast forward nearly 10 years, and the hedge fund manager who took him up on it had to wave the white flag. Today, in this video, we're about to reveal the top 5 S&P 500 ETFs that we think will outshine those hedge funds in the coming decade. Over that 10-year period, those carefully chosen hedge funds only managed to pull off an average return of 36.3%. Meanwhile, the S&P index fund did way better, with a whopping 125.8% return, more than 3 times as much. ETFs are like the Swiss Army knives of investments. They're made to give you a mix of different things like stocks, bonds, or even stuff like gold, or a mix of these things. It's kind of like having a basket of goodies, just like a mutual fund, but the cool thing is, you can buy and sell it on the stock market like regular shares. The S&P 500, or just S&P for short, is a big deal in the world of stocks. It's like a popularity contest for 500 of the largest companies you can trade publicly on the US stock exchange. They add up all those companies' values and make this important number. So, the ETFs we're talking about today are like copycats. They're trying to mimic the S&P 500's performance as closely as they can. Starting with number 5, RSP is the Invesco S&P 500 Equal Weight ETF. Unlike favoring larger companies, RSP treats all S&P 500 stocks equally, spreading out the risk and emphasizing smaller companies. Launched in April 2003 and managed by Invesco with $1.41 trillion in global assets, it has a slightly higher 0.2% expense ratio, costing $200 annually for every $100,000 invested. It has a 0.2% tracking error, closely mirroring the S&P 500's performance. With a 10-day average trading volume of about 4 million transactions and roughly $40 billion in assets, it offers a 1.82% dividend yield and an average market return of approximately 9.91%. For every $100,000 invested, you'd earn around $1,820 in annual dividends and see your portfolio grow by about $991. A share of RSP is priced at approximately $140. RSP is a strong choice for diversification or hedging in an uncertain market because it offers an even shot at all 500 S&P stocks. Next up, at number 4 is SPLG, the SPDR Portfolio Large Cap Growth ETF. This ETF primarily invests in large cap growth stocks from the S&P 500, focusing on the major players in the index. It's managed by State Street Global Advisors, the investment division of State Street Corporation, which ranks as the world's 4th largest asset manager with a massive $3.6 trillion under management. What sets SPLG apart is its incredibly low expense ratio, a mere 0.02%. If you invest $100,000, you'd only pay about $20 in annual expenses. It's a top performer in tracking the S&P 500, with a minuscule tracking error of 0.02%. Although the 10-day average trading volume is around 3.6 million transactions, which is on the lower side, it's still reasonably liquid. Currently, it manages about $19 billion in assets. The dividend yield is approximately 1.57%, and it has delivered an average market return of around 11.72% over the past decade. Investing $100,000, you could expect to earn about $1,570 in dividends and witness your investment grow by approximately $1,720 per year. A share of SPLG is available for roughly $50. SPLG is the smart choice for those seeking an affordable ETF with a slightly higher dividend yield, making it an attractive option for long-term investors. Number 3 is SPY, or the SPDR, which is the Standard & Poor's Depository Receipt Fund. It's managed by State Street Global Advisors and has been around since 1993. While it does have a relatively higher expense ratio of 0.945%, around $94.50 a year for every $100,000 you invest, it performs well, with a tracking error of 0.04%. What really sets SPY apart is its impressive liquidity, with a 10-day average trading volume of approximately 94.7 million transactions and around $498 billion in assets under management. It offers a 1.52% dividend yield and has an average market return of 11.82%. A share of SPY is priced at approximately $430. This ETF is perfect for investors who need high liquidity and appreciate a long, reliable track record, given that it's one of the oldest ETFs on our list. In second place, we have VOO, the Vanguard S&P 500 ETF, managed by Vanguard Vanguard Group Incorporated, a major player with $7.7 trillion in assets. VOO started trading in September 2010 and stands out with its super low expense ratio of 0.03%. This means you'd pay just $30 in annual expenses for every $100,000 invested. It keeps close to the S&P 500 with a tracking error of about 0.03%, with good liquidity, around 4.9 million trades in the last 10 days, and roughly $326 billion in assets under management. VOO is a dependable choice. It offers a 1.58% dividend yield and has an impressive 10-year average market return of 11.86%. Investing $100,000 in VOO would give you about $1,580 in annual dividends and an extra $1,860 in value growth. You can buy a share of VOO for around $400. In summary, VOO is perfect for those seeking one of the lowest expense ratios among S&P 500 ETFs and for investors who trust Vanguard, a respected company with a strong track record of success. Now, the number one S&P 500 ETF is IVV, the iShares Score S&P 500 ETF. It's provided by BlackRock, the world's biggest ETF provider and asset manager with $9.42 trillion in assets. IVV has been around since May 2000, offering a winning combination of low cost and excellent performance. Its expense ratio is a mere 0.03%, which means $30 a year in expenses for every $100,000 you invest. With an incredibly low tracking error of 0.02%, IVV sticks closely to the S&P 500. It's also quite liquid, with an average of about 4.7 million trades in the last 10 days, and manages around $344 billion in assets. IVV has a 1.55% dividend yield and an impressive 10-year average return of 11.88%. So, a $100,000 investment would yield around $1,550 in annual dividends and an additional $1,880 in value growth. You can purchase a share of IVV for approximately $430. In a nutshell, IVV is the top choice for investors who want to mirror the S&P 500 closely while enjoying one of the highest returns in the market. It's also an excellent option if you're interested in investing with the world's largest asset manager, BlackRock. And that's a wrap on the top 5 S&P 500 ETFs, poised to outperform even the most successful hedge funds in the long haul. Thanks for tuning in to this video, and make sure to like and subscribe to the channel. See you in the next video.